It's my pleasure to be here today and to address you on a topic which I hope is close to your heart, and if it's not, then hopefully after this presentation, which is digital platforms, why they matter, and what about it matters in terms of risk. So my name is Grieken. I'm part of the Center for the Edge within Deloitte, which is a forward-looking entity, and I also still teach at an MBA. So why should you care about the topic of platforms? Well, the first one is because it is creating value. Here you see some of the numbers. Total number of global platforms in the world in 2015 was 175. Next to that, you see the market cap of those companies. And finally, you see the number of employees that make their money in this industry. So there is definitely a point to be made that platforms matter. They create value. The second one is also very important. And here, by the way, you see why it's so important. It's spreading the world. Obviously, the main concentration being Silicon Valley, but the second, 30 companies have their corporate headquarters as a global platform player in China. So this is gradually changing the world of business and technology. The second one is about threat or opportunity, disruption. The Center for the Edge, to which I am a member, has done research on 9 patterns of disruption. I was not invited here today to talk about disruption, but definitely I will send you the link, have a look at them. On the upper right, you will find the one that we're discussing today, one of the 9, which is patterns. Platforms that are changing the way in which we collaborate, in which we share, in which we scale certain propositions in the market. So we distinguish 4 different types of platforms. The first one, I'm sure you know, aggregation platforms. And I'm sure that some of you are fed up with it. Oh, another presentation of Uber. With all due respect to Uber, but there's other companies in the world. But nevertheless, the principle and the platform thought there is very successful. The second one is the one that I'm sure most of you use, and your family uses, and your business relations use, social platforms. The third one is an interesting one. It's the one about facilitating mobilization, moving people to really act together, to share data, to share algorithms, to share intellectual property in order to speed up and to scale. And one of the examples that I would like to share with you from a completely different company, a company maybe to some degrees comparable to some of the companies represented in this room actually today. This company is 106 years old and decided we want to be a major platform player. And this is what they did. Of the big players in this industry uses this company. What they do is they manage the whole supply chain, from mediation to manufacturing, to design, to risk, all of it. It's all data-driven, and it completely changed the landscape in which apparel, as you see here, is brought to market. They have sensors in airports and in shops across multi-different regions to see what of the new dresses actually work or not, which one are sold or not. And based on that, that is fed into the supply chain. So it's constantly learning. And here you see some of the brands that they service. They are the power behind these brands. They facilitate the whole platform, including the risks involved. And one of the major characteristics of a platform, and why it's important either to participate or to think about participating, or in some cases of you even creating your own platform, is because of this. The tremendous power of platforms to scale and create network effects. And that is one of the typical characteristics that we see in a lot of these companies. The fourth one, obviously, being the learning type of platform, which is particularly focused on exchanging knowledge and ideas, and in some cases, intellectual property. Now, the research we have done, and that I'm going to share with you online if you're interested, identifies the following success factors. The first one is industry economics. There needs to be a significant friction in a particular value chain for a platform to be successful. The second one is the prices that the market is willing to pay for that combination of functional services need to be there. The customer needs to be willing to pay. From a risk perspective, extremely important in the performance of these platforms is their scalability and therefore their business continuity. So when you participate in somebody else's platform, this is one of the areas that, as a risk manager, you should be asking serious questions. The second one is the participants need to perceive value, obviously, but from a risk perspective, you need to be sure that you balance the interests of the players. Those platforms that die off after a while, they die off because there is an imbalance between the players. It should be a win-win. And to some of the corporate companies represented in this room, that is a new idea. I have to give something away for something to be given back to me. The fourth one is the relative position. Can this new platform solve the problem better than the alternative solutions that are in the market at the moment? And can the platform overcome the problem of let's say, ignition? In other words, can it scale quickly? Which is one of the elements that I mentioned before. And then finally, will the vested partners and players, the incumbents in the market, participate? Will they open up in order to add their value to the platform? And can the platform adapt quickly to changing market environments that are changing the way in which the platform has been successful in the past? So, looking at this, what can you do? There's a number of options. The one is obviously, let nature do its work. From a risk perspective, I think that would be a bad thing. This is something you cannot ignore, and I think at least from your perspective, you should be part of the conversation with your colleague from strategy, with your colleague from technology, IT and or digital, whether your company should be a player in this field, and I know some of you already are. Some companies start what we call edge play, center for the edge. Reason being that the mothership of the company is simply too slow. So they decide to create this platform business outside of the mainstream company with a separate reporting line, separate funding, separate CIO, separate. First of all, to protect it against the antibodies in the existing work company. Secondly, to get these exponential scaling capabilities. And in some cases, to be honest, to be attractive to a new generation of employees that doesn't want to work for the mothership. That's edge plays. I've been involved in a number of these. Here's a typical example. Big bank. We want to be in the wealth management arena. So we're going to create a completely new bank from scrap. So no legacy, no old stuff, no old employees, by the way. We're going to start from scrap, and it should have 3 characteristics. The first one, it should be a desirable bank. The second one, it should be a bank that is viable, that is scalable. And thirdly, feasible in technical terms. And so this was delivered in 10 months. Just imagine that. In 10 months, you can have a new bank. And that bank has a number of characteristics that in the traditional banking area would be, as the Americans would say, awesome. For instance, fully digital onboarding in 15 minutes in a wealth management bank. Automated aggregation of assets from one bank to another. Chat, video, integrated, including robotics when you talk to your advisor. Health check on investment and the portfolio and the full drill down of what you have in terms of assets. All of that, but on top of that, built in a total of 13 cloud fintech partners. In other words, 13 companies that were about to disrupt your market. And instead of integrating in the mothership, in this particular case, the solution was, the decision was taken, we will create a new bank. The whole process, including the banking license, by the way, was 17 months. So it gives you a bit of a feel of, in some cases, when you talk about risk, and when your decision would be, we cannot ignore, let's take banking as an example. There's a world out there with fintechs that are going faster, that are scaling, blah, 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 blah. That is a business continuity risk. Our current mainship cannot adapt this for all kinds of reasons, which we'll go into in a moment. Then an edge play could be an alternative. And as I said, in this particular case, about 1.5 years later, you can have that new digital platform bank, because this is typically an example of a platform player. Now, for a lot of companies, this is not an option. And so they have to deal with the complexities of the current situation. And what are those complexities? On the front end, let's take banking again as an example, but just as an example, can be a retailer, can be an airline. They look sexy. There is an app. There's maybe 2 apps. There is a website. But in the back end is a team that has been hidden in the cellar. We closed the door, we opened up the hatch, we threw in a sandwich, and we yelled, cheaper and shut up, and we closed it again. It is called the IT department. And by the way, the risk managers, some of the risk managers love it like that. Contain it. It can do no harm. In our view, this is not sustainable in an economy that is moving toward platforms. Because in a platform environment, your capability, your value as a firm will be determined by your ability to connect to others. A few years ago, I wrote an article which was called From Benchmark to Mashmark. It doesn't really matter whether you're on par. If you would have not been, you would be dead long ago. Who cares? The real value of your company is in your ability to, based on the situational awareness that you collectively have, connect in networks and platforms where it makes sense, and very important, to disconnect when it doesn't make sense anymore. So this capability to quickly engage and disengage digitally and do that in a secure way, in my view, is a core competence of any company that will determine the value of your company going forward. If you do not have the opportunity or the freedom to start your own edge play, and there's plenty of reasons why you should not do that. It's a good conversation to have. One of the things you might want to consider is looking at the current technology operating model that your company has within its, let's say, responsibilities. And for which you, as a risk officer, I'm sure, together with a CISO, have a supervisory role. It's part of your responsibility. Together with a colleague, I wrote this piece of research, which I'm going to share with you as well. Now, just imagine that tonight, you get back to your partner, husband, wife, and you walk into the kitchen, and there's a new kitchen. And there is new equipment, and there's new tools, and there's new ingredients, and there's even a new wife or a new cook. And outside, the kids are saying, no, we want that. We want something else. That is what is happening in technology. The kitchen is changing. And it is changing in 9 dimensions. The first 3 have to do with the way in which we work, in which we produce technology. It's just changing. The second one is on resources, money, talent, risk appetite, governance. And the third one is all about which technologies are we talking about. So let me just walk you quickly through each of these and to give you a bit of a feel. First one is agility. Agile ways of working. It's exploding. But guess what? There is 4 different types of agile working. There is the version which is all about failing. Minimal viable product, Eric Ries, try it out. The other one, scaled agile, is about completely delivering agile projects and bringing them alive the next day. It's called DevOps, develop, operate. If you move into a world, as Sandra said, in which you will have mass customization of your products, of your services, then one of the capabilities you need to master as a firm is DevOps, because the market is constantly changing. So you constantly want to adapt. So agile ways of working is an important ingredient of the next generation kitchen, because it will allow you to speed. Second one is the one that is about, and from a risk perspective, very important one, who owns this shit? Is it IT versus business? Whose is it? It used to be so simple. Oh, that's the IT department. Oh, that's marketing. Oh, that's... And in my former job, I used to be a VP of research in Gartner. We would call that shadow IT. And if you're in risk, you don't want to have shadow IT. You want to know what's happening, right? I mean, that's your job. So to have a good, solid conversation about who owns this, and will that be the same next year? And will it allow us to scale or not? Just to give you part of the research that we've done, in 2020 it's expected that 50% of the spend of technology in corporate companies like yours will have shifted to the business side. It is not in the IT department anymore. So how, from a risk perspective, are you going to make sure that you know what's happening? So you really have to have this conversation. And the complexities, I mean, this very simple slide, but is the agile team in the business with a dotted line to IT, or is it in the IT department, and is it commissioned to the business? That's an important debate to have, also from an accountability point of view. Then there's the third one. As I said, one of the 9 is about my topic today, and that is platforms and ecosystems. We'll not go into that now. I'm sure you got that point. The fourth one is a tremendously important one. I'm involved in some of this work as well. The current configuration of most of the technology teams in big corporates is not at all capable of dealing with this type of a future. For one thing, because if you're shifting 60% of your current IT landscape to the cloud, You don't need infrastructure managers. You don't need applications managers because it's not your application anymore. On the other hand, you need the type of talent that Sandra was talking about. Data scientists, next generation security officers, different types of people. So in the research you will find an overview of what types of jobs we think will be hunted for the coming 5 years. And then one that's really close to my heart. The culture in which this either thrives or dies. We call it digital DNA. So when I entered Deloitte, August 1st, 2016, coming from Gartner, I was confronted with really nice research we've been doing for the past 6 years on digital DNA. What makes digital companies tick and what makes that different from others? And so what I did is I took those 58 questions and I started to cluster them. Questions about leadership, that's one DNA element. Risk appetite, that's another one. Investment, talent, recruitment. And so at the end of this process, we turned up with 13 different, what you could call DNA elements that any company needs to decide upon. Am I going to force this firm to digital transformation? Yes or no? Leadership. And I'm going to pay for it? Yes or no, etc. So we ended up with a total of 13. And then I asked my colleagues, data scientists, to create an algorithm. And amongst 3,500 corporate companies in the world, we found patterns, 4 patterns, of which 2 do not at all perform, and 2 do perform, but fundamentally differently configured. The first one are laggards. And by the way, I have data on the rest of the world as well. Since we're in Europe now, I'm showing Europe. But here you see those companies that 0 is on par, is the average. And those companies that are basically underperforming in any dimension, particularly look at the last 2, experimentation and risk-taking, minus 28%. Leadership, minus 29%. So, best word would probably be oblivion. Then there's what I always call every consulting firm's dream. They're still underperforming, but guess what? They spend a lot of money doing it, plus 12%. These are the type of companies that get it in terms of we need to do something. We need to do it, but it's a chaos. There's proof of concepts. There's a lot of shadow IT. There's no control. And above all, there's no scaling of the initiatives. And then finally, there's 2 that fundamentally work, if I'm to believe the data. The first one we called fast-moving experimenter. Plus 28% on experimentation and risk. Just imagine that, since you're in risk. They deliberately take risks, but they contain them by keeping them small. So here you talk about companies that have 60 plus digital initiatives at the same time, but they keep them small. And they do that on top of a base, a DevOps base, that allows them to scale what works and to kill what doesn't work and do that in a rapid pace. That is why the main characteristics of the leadership of this type of company is to kill stuff. They're really good at it. And what survives, thrives. That's the idea. The second one is successful, but fundamentally different, is talent and strategy-led. First characteristics, huge influx of young, digital, new DNA to help the company change. Second one, huge investment in the existing workforce to bring them at the next level. Third characteristics, strong leadership that forces the organization to go there, including the cannibalizing effects that that might bring. And finally, obviously, also collaboration. I'm sure you got that one too. So, the sixth one in the model of 9 shifts, when you want to be a fast-moving experimenter, then the way in which we fund technology in most corporates is not going to work, right? If only for the reason that fast-moving experimenters fail at 20% of what they do. So in the case of a fast-moving experimenter, you have to agree amongst yourself, we're going to spend 20% of our budget down the drain. We know up front it will be going down the drain because our approach is, we don't know, we'll let the data tell us whether it works or not. So the whole concept of having year budgets on technology in this type of companies is changing. The ownership of those budgets, the governance of those budgets is changing. As a result, the risk profile of that money changes. So that is why it is important to look at this through a risk perspective. If this is true, what does it mean for the way in which I do what I do? And then finally, on the technology side, 3 major shifts. One is, I'm told Amazon is here in the room. I'm sure they'll agree. I spoke to Werner Vogels 2 days ago, or 2 months ago. He's the CEO of the company. The growth is just exploding, as it is exploding with Azure and Microsoft, or with Google. So this move towards cloud is all over the place, and it's not going to stop for the coming 5 years. The other one is the shift towards data-driven business models. This idea that we can only be successful if we better incorporate into our corporate decision-making process foundational data and artificial intelligence that help us to improve the quality of our decision-making. For a risk person, that means that you have to have somebody in your team that understands what algorithms are and that can value what type of parameters are actually taking decisions here. Because one thing's for sure, computers will be making more decisions in the future. And you might argue that it is part of your responsibility to understand the reasoning that the artificial intelligence component uses in order to decide you're going to get this insurance or not. And then the last one, since I'm in the heart of one of the most famous industrial company in Europe and probably in the world, the merger between IT and OT. These worlds used to be separate. You got the back-end technology, office technology, and you have the technology in the car and on the shop floor and in whatever technical environment. And guess what? These worlds are merging together. Here's a typical example. My company was involved in a project in which a big company in the automotive world is planting across Europe charging locations for electric cars. That is, in technical terms, an IoT, Internet of Things type of environment, OT, operational technology. I want to see how many people, I want to see that you paid, and so on. But the moment I'm able to connect that to the financial SAP backbone, I can see online how much money we're making now, and I can predict what that will be the coming 3 years. Moreover, I can start looking at spot prices of energy and based on that start playing with financial elements in order to improve the profitability of the firm. OT and IT convergence. So these are the 9 that we believe make up your future digital kitchen. That is, these are the 9 that are changing your current kitchen. And I'm sure that most of you will recognize some of them, or hopefully all of them. It's not rocket science, is it? What I find, and my colleagues find to be value in this lens on the world, is this discussion. It's the discussion on, okay, so of all of these 9s, which 2, 3, preferably 2 or 1, should we really nail? We can't be good at everything, so all taken into account, our strategy, our future, our competition, we need to go to platforms and all of that, okay, which one? So let's assume, as an example, 2 of them are the most important ones. We're just too slow. Agile is a good solution, in producing new technology. Agile ways of working will help you there. Second one, our business is rapidly moving towards data-rich environments to improve our decision-making process. Okay, that's the second dominant one. If that is the case, from the other ones, which is going to help me to get there? Well, to go to a cloud-first strategy is definitely going to help you to scale when you work agile. Good thing. To use the innovation that the likes of Amazon or Google or some of these players will bring to you is definitely going to change you and help you integrate into their platform in order to scale with others. And thirdly, the merger between OT and IT will definitely going to enrich the data side of your dominant shift because you'll have real-time visibility of some of your assets. Those would be boosters. But we're not quite sure who owned this in our firm. Is it the business, or is it IT, or is it somewhere in between? You need to have that conversation up front. And you guys and girls need to be involved in that conversation because there's risk involved. Second one, current workforce is not going to get this, at least, not all of them, but a percentage definitely is not going to make this transition. And finally, as I said, the way in which we fund now, with yearly budgets and the traditional way of funding technology, is not going to fit that new operating model. Some of the questions on the business side that we get asked a lot. What role do you want to have in that platform? Do you create your own platform, or are you going to participate in somebody else's platform? What game do you want to play? Are you going to put it outside, an edge, or are you going to shoot it out from the existing environment, technology environment? If that is the case, how are you going to capture the value, and what risks are involved? On the technology side, which is more my cup of tea, these are the type of questions that I would ask. What are the pros and cons of an edge play versus core integration? In the case of an edge play, how do you select the right partner or partners? Go back to the example of the new bank. 13 partners that you're integrating at the same time. That has legal implications as well. Core integration. Which is the configuration that your company of these 9 shifts would recognize the most? What matters most? And what are the consequences for the boosters and the showstoppers? What will be the security implications of that future technology operating model and for the position of the CISO within the firm? And finally, if all of that is true, then what type of skills should I be starting to hunt for now in order to be prepared to participate in that platform economy? Final thought. Last week, some 98 CIOs of the big energy companies, the Shells and the BPs of this world, gathered in London for the Financial Times conference on energy digitization. And my colleague Mark Lilly asked those professionals gathered in that meeting, if you look at these 9 shifts, which would you consider to be the most difficult, top 3 difficult to change? In other words, what would be the top 3 showstoppers? And this is what they said. The red one, 20%, the culture. 19%, the workforce. Sorry, the agility, speed, lack of speed. 18%, workforce transformation. So this is also to make the point to you that I totally respect that you are individual, different companies with different ambitions, different marketplace, and so on. And so it's not up to me to say here, you will be this or you might be that, but it does make sense from a risk point of view to look at these 9 shifts and then step back and say, okay, if I look at our company, what would we consider to be the main shifts? And if that is true, what would we then, from a risk perspective, need to be discussing as well. The most challenging showstoppers are actually in this field, the workforce of the future. It's a wonderful video on LinkedIn, you might have seen it. It describes jobs that weren't around 10 years ago. I can guarantee you we can make this video in 5 years again. So part of the risk discussion should also be, what would this look like in 5 years? And how am I going to position our firm to be attractive enough to join this firm to make us, quote unquote, digitally future-proof? I will share this presentation with all of you through the Zurich portal. I want to thank you for your attention, but my final thoughts here would be the following. If you're not already involved, get yourself involved. Because in this play, if you are, let's say, not able to take the risk, then it might be your last risk. Thank you very much.